This is video 2 of SciCat Limited combining debentures in IFRS 9 with IAS 8. Let's have a look at what was done. We need to determine the journal entries of what was done based on the narrative paragraph that was given in the question. So, having read that paragraph, we can now do these journal entries as part of our calculations because we know we are going to do a prior period error note. To do that note, we need to know what was done, what should have been done, and what are the differences. So if we have a look on the first journal entry that was done, that is initial recognition. They told us that SciCat Limited accounted for this investment at the amounts paid in cash. So what did they pay? They paid nominal value. The debentures were issued at par or at nominal value. So the first journal is debit your investment credit bank with the nominal value. The nominal value was the number of debentures multiplied with the nominal value per debenture. That is what they did. We are just looking at what was done. Then at the end of the first reporting period, the interest was recognized at the cash flow amount. So finance income, we are the investor. We earn interest, credit finance income. Debit your investment at what amount? At the cash amount. How do we calculate that? Nominal value times nominal rate. The next journal on this date, and you could have done this journal in two separate journals. The journal we have here, debit bank, credit the investment, is two things together. You could have done them separately. There's no problem with that. The entries would have been the same. What did we receive on this date? We received both the interest in cash as well as the first redemption payment. So both times we would have had debit bank, credit investment. We combined the two journals. You are welcome to do them separately. What is the amount made up of? It is 1/3 of the nominal value that was redeemed. And remember now, it was redeemed at a discount. So that's one part of the journal. What else is part of this journal is the interest amount that was received. Nominal value times nominal rate. We could therefore calculate the new balance on the debenture investment, the financial asset. Then for 2013, what happened? Well, the interest that was earned in cash was recognized. Debit investment, credit finance income, and then there was also a journal, again, a combination of the maturity payment, the second maturity payment, together with the interest that was received in cash, and we can calculate the balance at the end of the year. 2014, what was done? First thing was the interest was recognized in cash, nominal value times nominal rate, and then there was an amount received, bank. What is that? Again, two things together. You could do them separately. It's the third and last maturity payment together with the interest in cash. The problem was at the end of this third and final maturity payment, there was still a balance left on the financial asset, the debenture investment, but they told us in the narrative paragraph where they told us what was done, they said if there is a balance left, but the investment doesn't exist anymore, it has matured, you will take out whatever is left in that investment and take it through to profit or loss. Call it something like loss on redemption or write down of investment left after redemption. That will give you the balance of R0. So this is what was done. The debenture was recognized in the accounting records of SciCat Limited at cash amounts. The cash paid initially, the cash interest that flowed, the cash maturity payments that flowed. There was a balance left and it was written off to profit or loss. That is what was done. Now we need to apply our knowledge of IFRS 9 and the rules of IFRS 9 applicable to the category at amortized cost and go and do the journal entries. What should have been done? If we now have a look at those journal entries of what should have been done, and we look at the first journal entry on 1 March 2011, there is an investment in a debenture. The bank amount will stay exactly the same. Usually when there's a prior period error, bank is not the issue. We do monthly bank recons. We will very quickly see if something was not correct. So they invested in a debenture. That is what they really paid. That is the amount that flowed in cash from the investor to the issuer. That is the amount that the issuer issued the debentures for. The problem is, if we have a look at IFRS 9, the investment, the financial instrument, initially on day one, has to be recognized at a fair value. Is the amount paid in cash the fair value? It could be, but we cannot assume that unless the question very specifically states that it was fair value. We need to go and calculate the fair value. And if that fair value is not the amount at which the debenture was issued by the issuer, it's not the amount that we as the investor paid for it, there will be a day one fair value adjustment that will go through to profit or loss, which is the balancing figure on this journal. And if you are in the category at amortized cost, this is your only fair value adjustment that you will do.